We're going to talk about something that is incredibly important. It is used for some tenants who are looking to become home buyers one day, and that is called the price to rent ratio. The price to rent ratio, this is the median home price divided by the median annual rents. So, what is the median home price? Well, this includes the cost of the home or the mortgage, homeowners association fees, property taxes. And basically, it is the ratio of home prices to the annualized rents to determine whether or not it is the right time to rent or buy. Here in the United States, this is national sales prices for homes in the third quarter, 358,700 divided by the annualized rents for all vacant units. This is asking prices in the third quarter as well, 14,433. It leaves us with a price to rent ratio of 25. So, what does that mean? Well, according to Trulia, price to rent ratios is broken down between 1 to 25 is much better to buy than rent, 16 to 20 typically better to rent than buy, and anything over 21 is much better to rent than buy, which gives us that 25 rating, indicating that it's better to rent right now. Much like most things when it comes to our housing market, it's all bullshit. It's all bullshit, but it's often used as a metric or a calculation of sorts because it's the only thing that we have to go off of. I have 3 sets of data that we're going to play with. We have the CPI, the Consumer Price Index from January to October of this year. Second data set is the percent change in real average weekly earnings. Third data set is average hourly earnings of all employees, total private dollars per hour, monthly, seasonally adjusted. So these are all monthly. And the percent change in real wages, this is from the Bureau of Labor Statistics. And the average hourly earnings is from the FRED, as well as the CPI. That's a FRED report as well. So whenever we're talking about what is the best course of action for renters or possible home buyers, well, let's think about why it is only most likely the case that we will see renters stay in the rental market. Whenever we're looking at the percent difference from the previous month, we start to see a little bit of a different outlook on the data, right? This purple, this is the percent difference in the average earnings for all workers in the private sector from January to October of 2021 compared to the CPI, the Consumer Price Index, that's following a similar pattern or format. Percentage change month over month from January to October. And as we can see quite clearly, there is a significant climb in the Consumer Price Index beginning in August after we saw a bit of decline from July, which was up significantly compared to where we began at the beginning of the year. But here we can see all the way up top that this is where the CPI currently rests. As a percentage change, it has increased dramatically since August and looks to be on a steady trajectory upwards. Meanwhile, we're seeing that the average annual earnings that we are making in the private sector is starting to see a pretty steep decline. What does that mean for renters? Well, not only are we not seeing the benefits of inflation that we continue to hear from mainstream media, that higher prices due to inflation can be justified because more money circulating in the economy means that there is an increase in wages. Well, who's getting the increase in wages? If we're looking at average annual earnings for all workers in the private sector, that's the exact opposite of what we're seeing. We're seeing wages actually start to go down, or earnings start to go down. So how do we justify these higher costs, specifically in rents? So let's look at one more breakdown. The percent change in real average weekly earnings. So if we compare this with the CPI, this is from the Labor Statistics Bureau that provides a really interesting look at the cost of weekly earnings, right? So not necessarily changes in the annual earnings that we're making, but the earnings that we're making on a weekly basis. This report that's not coming from the Fed, it's coming from the Labor Bureau. It does control for inflation, right? So it does take into consideration additional costs that are applied to our housing market, to our CPI specifically. It's abundantly clear that from January to now, we're seeing a pretty radical drop in our weekly earnings adjusted for inflation. So it's a very interesting concept to a certain degree to even entertain the idea if it's a good time to buy. How is this a sustainable model that will allow us to continue to have any security when it comes to our shelter that we might be on the brink of losing if we're not able to keep up with our rental payments? We're not seeing the benefit of all of this money pumped into our economy. In fact, workers are getting the burden placed onto them. Wages are not stagnant. They're not stable. They are all over the goddamn place on a downward slope. Meanwhile, it's all the way up for the costs of housing, specifically in urban areas. So we do know that renters in urban areas are paying a much higher price. So again, how are we justifying the increased costs specifically tied to renting? Where is all of the money that is purportedly going to increased wages? Renting. Where is all of the money that is purportedly going to increased wages? It's not going into the pockets of renters, clearly. So why are renters paying the premium? Let me tell you what's definitely aligning. We got the percentage change in average weekly earnings, and I'm going to bring back the average hourly earnings and remove the CPI. These are two different sets of numbers formatted in two different ways. For one data set, it is the actual average hourly wage for all workers in the private sector. So because they're like two different sets of data, it is nearly impossible to synchronize the data sets because they're not on the same wavelength. But by making them both percentage changes, we can see that there is a little bit of a synchronized flow of these numbers and the way the data trends are moving in either direction, right? That's on par with what I was anticipating. So this is the one consistency that we are seeing, and it makes sense because our hourly wages will determine our weekly earnings. So this makes sense. What doesn't make sense is why we are seeing similar downward trends in the amount of money we are making per hour, and by extension, per week, And yet, we are seeing a dramatic increase in CPI, and that's just one area where higher costs are affecting us as tenants, so that other metric used to determine inflation, the one that the Federal Reserve uses specifically, we're also seeing higher prices for goods or services, costs for food and other necessities that come out of pocket in order to secure our own survival. Landlords do not have a justifiable reason to increase their rents, and yet here we are. It is an upward trajectory, which indicates that, yep, rent's rising. These profit-seeking behaviors are on brand. Landlords, of course, are looking to capitalize off of this inflation with higher rents. Employers are looking to capitalize off of this inflation by raising costs, even though we know that their earnings or their gains are, in some cases, better now than they were before COVID-19. Higher salaries for the CEOs, and yet it's the working poor who tend to shoulder this burden during inflationary periods, even though they are not reaping the benefits of more money in the economy whatsoever. And instead of seeing that we have workers literally quitting or looking to form a union to use their power as a union to collectively bargain for better wages, because it turns out that employers do not give their workers adequate wages out of the goodness of their heart. Workers have to demand these wages. Tenants don't even have protections to form a union, which means that all opportunities to unionize are pretty much off the table if you fear retaliatory evictions, which is not uncommon. So once again, we are seeing the unfortunate consequences of landlords taking this opportunity to capitalize off of this inflationary period, even though their tenants are not necessarily in a better financial position to be able to incur this additional cost.